Tom Lee, the head of research at Fundstrat and chief investment officer at Fundstrat Capital, recently joined CNBC's Closing Bell to share his latest outlook on the stock market. According to Tom Lee, markets could continue moving higher in the near term, and may even finish March on a strong note. But he also warned that a much bigger decline could still arrive later in the year, potentially leading to a bear market. In this video, I am going to show you the clip from that CNBC interview. After that, I will break down exactly what Tom Lee said and give you my own reaction and analysis of his outlook for the market. Then we will take things a step further and look at 3 of the best growth stocks that could be worth buying right now. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you do not miss out on the next important financial investing update. Now, let's hear what Tom Lee has to say.
It's Tom Lee of Fundstrat, the co-founder, chief strategist, joins us now here at Future Proof. You're a brave soul wearing a suit and tie here on the beach, but it's how you roll, Tom.
Yeah,
Welcome.
I guess that's being a contrarian, right, Scott?
Yeah. Well, I tell you, you sort of are. Now, you're not negative on stocks, but you do have a base case that at some point this year we're going to go down 20%, that we're going to have a bear market. Was this the first whiff of that?
Our take is we do expect that decline to happen when markets don't respond to good news. So I think we're in a period where we had a bear market already in software, the Mag 7, and in crypto. I think that's already taken out a lot of speculation. So to me, I think our bet would be markets are actually going to lift through the end of the month, that we're going to actually be positive for March and maybe hit 7,300. Later in the year is when we think a bear market might show itself.
What about oil? Right, we're watching it so closely. We're driven by headlines, some of which are apparently erroneous. I don't know what do you do with that?
Yeah, I mean, it's a very confusing time. I think it's very difficult if someone's trying to trade both the headlines or trade oil. But if I look back at the last 2 days, oil's $15 higher than it was last week, but the S&P's higher. So to me, the market actually is handling higher oil prices better. And, we wrote in our note this morning that we think higher oil prices are actually good for the U.S. stock market.
Yeah, see, I think that's going to be a really hard sell for people who are watching this program, like trying almost too hard to paint some bullish scenario. How in the world are higher oil prices, which then mean even higher gas prices, which mean higher jet fuel prices, and all sorts of other issues that are related to that, input costs on a whole number of other industries, how is that possibly good for the stock market?
Yeah, part of it's a relative. One, U.S. is an exporter of oil, so we net benefit as an economy from higher oil. The second is other countries are importers, so the U.S. not only looks better, but on a relative growth basis, it should outperform, which means flows back into the U.S. And the third is, as we worry about global growth for all the reasons you describe, when growth is scarce, people buy growth stocks. The U.S. stock market is a growth index, so it's coming out of the rest of the world back into the U.S. So I think it's a rotation story.
All right, speaking of growth stocks, tech has been up for debate, certain parts of it more than others. We're going to get Oracle earnings after the bell tonight. You told me earlier this morning on the stage there on the beach that you think software's bottomed.
Yeah.
Why?
Well, I think software has bottomed because we tend to price in the negative risks early, which I think's happened, and we've seen the multiples come in. The IGV, which is the software ETF index, has lost 5 multiple points. Now the forward PE is 16 times. So to me, you're trading this like a cyclical industry now, and I think out of that universe of 110 stocks, many actually have durable businesses. So I think you're getting paid to buy it here at 16 times.
What about the broadening trade? Where does that stand? Now, again, if we're talking about, you make the statement that higher oil prices are actually okay, or if not better for the stock market. Doesn't the broadening trade have an issue with that? I mean, if you start worrying about the impact of higher oil prices on the economy itself, how does the broadening trade work?
I think it's a good question. And we do have to remember there's the stock market, and it's not always the economy. So I think the U.S. economy is going to have some risks for the reasons you described, which is why I think growth stocks start to look better, which is a lot of tech. And again, the U.S. is a growth index. I'd probably lean towards growth stocks outperform, which is not necessarily a broadening trade.
Let's finish with a quick one on Bitcoin, because I think it hasn't traded like many had suspected it would at times of turmoil in the market. It wasn't a safe haven play. It wasn't digital gold, so to speak. I mean, gold was gold, and gold traded well. So where does Bitcoin go from here? Is your confidence in it in any way shaken?
It's not. I mean, Bitcoin did basically break on October 10th because that was the biggest deleveraging event in the history of crypto. When gold went up, Bitcoin went down. But I think we have gone through a winter where a lot of the speculation and the leverage is gone. And I think this weekend kind of showed Bitcoin is coming back in vogue as a store of value because oil prices went up, but over the weekend, crypto prices actually surged, and Bitcoin, as you know, is holding above 70,000 now.
The interview starts with a simple observation. It has been another volatile day on Wall Street. Markets are mixed and investors are clearly struggling to decide whether the next move is higher or lower. That is really the backdrop for everything Tom Lee is saying. This is not a calm market. It is a market full of conflicting signals. Right away, the host points out something interesting about Tom Lee's outlook. Tom is not bearish on stocks right now. In fact, he still believes markets could move higher in the near term. But at the same time, his base case scenario includes the possibility of a 20% decline later this year, which technically would qualify as a bear market. That kind of forecast sounds confusing at first. Most people expect analysts to pick a clear direction. Either the market is going up or it is going down. But what Tom Lee is really saying is that markets do not move in straight lines. They move in phases, and personally I actually agree with that idea. A lot of investors think the market must immediately reflect the economy or the headlines of the day. But history shows that markets often rally before trouble shows up, and sometimes crash when things actually start improving. Timing the exact moment when sentiment flips is extremely difficult. Tom Lee then explains what he believes will trigger the eventual downturn. In his view, a bear market tends to appear when markets stop responding to good news. That is a really important point. When markets are healthy, they react positively to good developments. Earnings surprises push stocks higher. Positive economic data boosts investor confidence. Liquidity in the system keeps risk assets supported. But when markets begin ignoring good news that is often a warning sign, it means investors are already fully positioned and sentiment is stretched. At that stage, even positive developments are not enough to push prices higher. That is when downside risks start building beneath the surface. Tom Lee also points out something that many people may not realize. He argues that parts of the market have already gone through a bear market. He specifically mentions software stocks, the so-called Magnificent Seven technology giants, and the crypto market. In his view, these sectors have already experienced heavy speculation and a significant correction. Because of that, he believes a lot of excess risk has already been removed from the system. That is an interesting perspective, and it is one that deserves some thought. If the most speculative areas of the market have already corrected sharply, then the broader market may actually be healthier than people think. Now, whether you agree with that or not probably depends on how you look at valuations and economic conditions. Personally, I think there is some truth to his argument. A lot of the excess hype from previous years has definitely cooled off, but I also think markets still have pockets of very high expectations, especially in technology and artificial intelligence-related companies. Tom Lee then makes one of the more specific predictions in the interview. He says that he expects markets to lift through the end of the month and that stocks could actually finish March in positive territory. That might surprise people who have been watching the volatility recently, but his reasoning seems to be that sentiment has already become quite negative, and when investors become too defensive, even small positive catalysts can push markets higher. He even mentions the possibility of the S&P 500 reaching levels around 7,300 later in the year, before the bear market risk really starts to show itself. Now that kind of target is obviously bold, but the broader idea he is communicating is that markets could still have room to run before the next major downturn appears. The conversation then shifts to oil prices, which have been moving sharply due to global headlines. The host brings up the challenge investors face when markets react to breaking news and geopolitical developments. Tom Lee acknowledges that it is a confusing time, and that trying to trade every headline is extremely difficult. And honestly, I think that is a really important takeaway for everyday investors. Trying to trade every news cycle is one of the fastest ways to lose money in the market. Headlines move quickly. Markets react instantly. By the time most people react emotionally, the move has already happened. Tom Lee then highlights something that caught my attention. He notes that oil prices had risen significantly over the previous week, yet the S&P 500 was still higher. that is not what many people expect. Traditionally, higher oil prices are considered a negative for the economy because they raise transportation costs, energy costs, and ultimately inflation. But Tom Lee makes the case that higher oil prices could actually benefit the United States stock market in certain scenarios. That idea initially sounds counterintuitive, and the host immediately challenges him on it. Higher oil prices usually mean higher gasoline prices, higher airline fuel costs, and rising expenses for many industries. On the surface, it seems like a negative development. Tom Lee responds by explaining the situation from a global perspective. First, he points out that the United States is now a major exporter of oil. That means higher oil prices can actually boost parts of the U.S. economy. Second, he explains that many other countries rely heavily on importing oil. When oil prices rise, those economies suffer more than the United States does. That difference can actually make the U.S. economy look relatively stronger compared to the rest of the world. And when global investors look for places to allocate capital, they often prefer markets that appear more resilient than others. So if the United States economy looks stronger relative to Europe or emerging markets, global investment flows can move toward U.S. stocks. The third point he makes is about growth scarcity. When global growth becomes uncertain, investors tend to concentrate their money in companies that still have strong growth prospects. And this is where technology and growth stocks come back into the conversation. Tom Lee argues that the U.S. stock market is heavily weighted toward growth companies. In other words, if investors are looking for growth in a slow global environment, they often end up buying American technology stocks. That leads to another major topic in the interview, which is the outlook for software companies. Tom Lee believes software stocks may have already bottomed. His reasoning is based largely on valuation. He explains that the software sector has seen its price multiples contract significantly. The IGV software index has seen multiple points shaved off its valuation. Forward price-to-earnings ratios are now around 16 times. For a sector that historically traded at much higher multiples, that represents a meaningful reset. Tom Lee essentially argues that software companies are now trading more like cyclical businesses rather than high-growth technology platforms. And within that universe of over 100 companies, many still have strong durable business models. So from his perspective, investors are being paid to take risk in that sector at current valuations. Personally, I think this is one of the more interesting points he makes in the interview. When valuations compress significantly in a high-quality industry, it often creates long-term opportunities. However, the key question is whether earnings growth will actually re-accelerate. If growth slows significantly, those valuations may still prove too high. The conversation also touches on what investors call the broadening trade. For much of the past market cycle, a small group of large technology companies drove the majority of stock market gains. Investors have been wondering whether leadership will expand into other sectors. Tom Lee seems somewhat skeptical about that happening right now. He points out that the stock market and the economy do not always move together. Even if economic conditions become more uncertain, that does not automatically mean the market will collapse. In fact, uncertainty can sometimes push investors toward companies with strong earnings visibility, and many of those companies happen to be large growth stocks. So his leaning appears to be toward growth stocks outperforming rather than the market leadership expanding broadly across all sectors. That view may frustrate investors who are waiting for a rotation into smaller companies or value stocks, but it reflects a reality that we have seen repeatedly in recent years. Capital tends to concentrate in the strongest companies when economic uncertainty rises. The interview ends with a quick discussion about Bitcoin and the crypto market. The host points out that Bitcoin did not behave the way many investors expected during recent market turmoil. It was supposed to act like digital gold, but instead it declined while gold itself rallied. Tom Lee explains that Bitcoin experienced a major deleveraging event earlier in the year. A large amount of leverage and speculation was flushed out of the crypto system. According to him, the industry has gone through what he calls a winter where many of the excesses have been removed, and that kind of cleansing process can sometimes create the foundation for a healthier market going forward. Personally, I think that perspective has some merit. Crypto markets have historically moved through boom and bust cycles where speculation builds rapidly and then collapses just as quickly. Each time the system resets, it tends to emerge more mature than before. But I also think investors should remain cautious because crypto remains one of the most volatile asset classes in the financial world. When you step back and look at the entire conversation, Tom Lee is essentially describing a market that is in transition. Short-term momentum may still push stocks higher. Negative sentiment could lead to rallies as investors reposition. But underneath the surface there are risks building that could eventually lead to a larger correction. And that combination of optimism and caution is probably the most realistic outlook anyone can have right now. Markets are rarely as simple as bull or bear. Most of the time they move through phases where both forces exist at the same time. So the real challenge for investors is figuring out where the best opportunities are within that environment. And that leads perfectly into the next part of the discussion, because if Tom Lee is right about growth stocks and technology possibly finding a bottom, then the next logical question becomes where investors should actually be looking for opportunities. Now let's dive in and talk about the 3 best growth stocks that are worth buying right now. The first company is Applied Digital, ticker symbol APLD. Applied Digital operates in one of the most important segments of the modern technology ecosystem, high-performance computing infrastructure. Most people hear the phrase artificial intelligence and immediately think about software or chatbots. But the real backbone of the AI economy is something far more fundamental: massive computing infrastructure. Artificial intelligence models require enormous amounts of processing power. Training large models requires high-performance computing clusters, specialized hardware, advanced cooling systems, and enormous data center capacity. Without the physical infrastructure to support this processing power, the entire AI revolution would simply not function, and this is exactly where Applied Digital enters the picture. The company focuses on building and operating large-scale digital infrastructure designed to support high-performance computing workloads. These facilities are optimized for demanding computational tasks such as artificial intelligence, machine learning, and large-scale data processing. What makes this business interesting is that demand for computing power is expanding at an extraordinary pace. Artificial intelligence applications are spreading across nearly every industry. Technology companies are training increasingly complex models. Cloud computing providers are expanding their AI capabilities, and enterprises are adopting data-driven technologies that require significant processing capacity. All of these trends require infrastructure. That infrastructure must be built somewhere, and companies like Applied Digital are positioning themselves to supply exactly that capability. One of the company's major advantages lies in its ability to develop specialized data center facilities designed for energy-intensive computing workloads. High-performance computing environments generate enormous amounts of heat and require highly optimized energy management systems. Applied Digital focuses on building facilities in locations where power availability, cooling efficiency, and infrastructure scalability create economic advantages. This approach can allow the company to operate high-performance computing environments more efficiently than traditional data center models. As artificial intelligence adoption accelerates, the need for these specialized facilities is likely to grow. The economics of the business become particularly attractive when utilization rates increase. Once a large-scale computing facility is built, the incremental cost of adding additional workloads can be relatively low compared to the upfront infrastructure investment. That dynamic can create strong operating leverage over time. Revenue can grow significantly while operating costs scale more gradually. Another factor supporting the long-term thesis for Applied Digital is the sheer scale of computing demand emerging across the global economy. Training a single advanced AI model can require thousands of specialized processors running for extended periods, and once those models are trained, they must still run continuously to process real-world applications. That means demand exists not only for training infrastructure, but also for inference infrastructure, which is the computing capacity required to run AI models in real time. As artificial intelligence moves from experimental projects into widespread commercial applications, infrastructure demand could expand dramatically. Applied Digital is positioning itself as a supplier of the digital infrastructure required to support that expansion. From an investment perspective, analysts have highlighted the company's exposure to high-performance computing growth as a key reason for their bullish outlook. Some analysts believe that as demand for AI infrastructure increases, companies operating specialized computing facilities could experience significant revenue growth. That potential growth is part of the reason Applied Digital has attracted attention among growth-oriented investors. But what matters even more than the short-term excitement around artificial intelligence is the durability of the underlying demand. Computing power has historically followed a long-term upward trajectory. Every major technological shift has required more processing power than the one before it. Cloud computing required massive data centers. Mobile technology required global network infrastructure. Artificial intelligence could require an even larger computational backbone. Companies that provide the infrastructure supporting these shifts often become essential parts of the technology ecosystem. And when infrastructure becomes essential, it tends to remain in demand for long periods of time. Of course, investors should always consider the risks involved in infrastructure-heavy businesses. Building large-scale facilities requires capital investment. Energy costs and operational efficiency can significantly affect profitability, and competition in the data center industry continues to evolve as demand increases. However, when infrastructure demand expands faster than supply, companies with existing capacity and development expertise can benefit significantly. That is why some analysts view Applied Digital as an interesting growth opportunity. If the company continues expanding its infrastructure footprint while securing high utilization rates from AI-related workloads, its revenue growth could accelerate meaningfully over time. And when a company sits directly inside one of the most powerful technology trends of the decade, investors often pay close attention. Before we move on to the second company, a quick word from today's sponsor. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let us move on to the second growth company, Intuitive Machines, ticker symbol LUNR. Few industries capture the imagination quite like space exploration, but beyond the excitement and headlines, something much more important is happening. The global space economy is undergoing a structural transformation. For decades, space exploration was almost entirely controlled by government agencies. Missions were designed, funded, and executed by national space programs with limited participation from private companies. That model has changed dramatically. Governments are increasingly partnering with private companies to build spacecraft, deliver payloads, and operate infrastructure in space. This shift has opened the door for an entirely new generation of companies that are helping build the commercial space economy, and Intuitive Machines sits directly in the middle of that transition. The company focuses on developing space technologies and lunar services that support both government and commercial missions. In simple terms, Intuitive Machines is helping build the infrastructure that could make sustained operations on the moon possible. And while that might sound like something out of science fiction, it is already becoming a real part of the modern space economy. NASA has been aggressively pursuing its Artemis program, which aims to establish a long-term human presence on the moon. But NASA does not intend to build every piece of that infrastructure itself. Instead, the agency is relying heavily on private companies to deliver cargo, equipment, and scientific payloads to the lunar surface. Intuitive Machines is one of the companies selected to participate in this initiative. The company has been awarded contracts under NASA's Commercial Lunar Payload Services program, which is designed to accelerate the development of lunar delivery capabilities. These contracts are extremely important. They provide revenue opportunities, technological validation, and long-term partnerships with one of the most influential organizations in space exploration. For a company like Intuitive Machines, participation in these programs can significantly enhance its credibility and position within the industry. But the opportunity here goes beyond a single government contract. The long-term vision for the lunar economy involves building infrastructure that supports communications, navigation, power systems, and scientific exploration. In other words, the moon could eventually require the same type of logistical infrastructure that supports activity on Earth: landing services, communications networks, data transmission, navigation systems. All of these elements will be required if governments and commercial organizations continue expanding operations beyond Earth. Intuitive Machines is positioning itself to provide several of these capabilities. The company has developed lunar landers designed to deliver payloads to the moon's surface. These landers are built to transport scientific equipment, commercial payloads, and technological experiments. Successful missions can demonstrate the reliability of the company's technology while generating revenue through payload delivery contracts. Another interesting aspect of Intuitive Machines is its focus on data and communication services in space. As activity around the moon expands, reliable communication networks will become essential. Spacecraft, scientific instruments, and exploration systems will need to transmit data back to Earth and communicate with each other. The companies that build these communications networks could become critical infrastructure providers in the space economy. And that is exactly the kind of long-term opportunity Intuitive Machines is targeting. From an investment perspective, the space industry is still in relatively early stages of commercialization, but that is precisely what makes it interesting. When new industries emerge, the companies that establish early technological capabilities often gain strategic advantages that can last for decades. Commercial aviation followed a similar pattern. The early companies that built aircraft manufacturing and global airline networks eventually became central pillars of the global transportation system. Space infrastructure could follow a comparable path over time. Of course, the space industry also carries unique risks. Launching payloads into space is extremely complex. Technology must perform flawlessly in environments where repairs are often impossible. Mission failures can occur, timelines can shift, and funding cycles can influence the pace of development. But despite these risks, the broader trajectory of the space economy continues moving forward. Governments are investing billions of dollars into lunar exploration. Private companies are building spacecraft, satellites, and space-based infrastructure. And commercial applications such as satellite communications, Earth observation, and deep space exploration continue expanding. Companies like Intuitive Machines represent one piece of that larger ecosystem. They provide specialized technologies that enable missions and support operations beyond Earth. Analysts who follow the company have highlighted the potential growth of lunar services as a major factor supporting the long-term outlook. As lunar exploration accelerates, demand for payload delivery, communications infrastructure, and navigation capabilities could increase significantly. If Intuitive Machines continues securing contracts and successfully executing missions, its role within that ecosystem could expand. Another interesting aspect of the company's positioning is its partnership-driven model. Space exploration requires collaboration between governments, research institutions, and private companies. By participating in these collaborative programs, Intuitive Machines can integrate its technology into larger mission architectures. That integration can lead to additional opportunities as new missions are planned and new infrastructure is developed. In many emerging industries, companies that become embedded within critical programs often benefit from long-term visibility and recurring opportunities. From a growth investing perspective, this type of positioning can be very valuable. If the company continues delivering successful missions and expanding its technological capabilities, it could gradually become a key participant in the expanding space economy. Now, whether the lunar economy develops exactly as quickly as some projections suggest remains uncertain. Space exploration has always progressed in waves. Periods of rapid advancement are sometimes followed by slower development cycles, but the long-term trend appears to be moving toward greater private sector involvement. And that trend is creating opportunities for companies capable of building reliable space technologies. Intuitive Machines is attempting to capture one piece of that opportunity. The company is not simply building spacecraft, it is attempting to build infrastructure that could support long-term operations beyond Earth. That ambition carries both risk and potential reward. But if the commercial space industry continues expanding, companies positioned early in the ecosystem could benefit from that growth. And that brings us to the third company in today's video. Unlike the first two companies we discussed, this next business operates in a completely different field, but the growth opportunity may be just as significant, because the next revolution we are about to talk about is happening in medicine, specifically the world of genetic diagnostics. And the company positioned at the center of that transformation is GeneDx Holdings, ticker symbol WGS. The healthcare industry is entering one of the most important technological transformations in modern medicine. For decades, medical treatment has largely followed a standardized approach. Doctors diagnose a condition, prescribe treatments based on broad clinical guidelines, and hope that those treatments work effectively for each individual patient. But human biology is far more complex than that. Two people can have the same condition but respond very differently to the same treatment. Genetics, environmental factors, and biological differences can all influence how diseases develop and how patients respond to therapy. This is where the concept of precision medicine comes in. Precision medicine aims to tailor healthcare decisions and treatments to the individual characteristics of each patient, and one of the most powerful tools enabling this shift is genetic testing. GeneDx Holdings operates directly at the center of this transformation. The company specializes in genomic testing and advanced diagnostics designed to identify genetic causes of diseases. Its core focus is using genetic sequencing technology to provide insights that help doctors diagnose complex conditions, particularly rare diseases and inherited disorders. To understand why this matters, it helps to look at the broader healthcare challenge. Millions of patients around the world suffer from rare genetic conditions that are extremely difficult to diagnose. In many cases, patients spend years visiting specialists, undergoing numerous tests, and still struggle to receive clear answers about their conditions. This process is often referred to as the diagnostic odyssey. genomic testing has the potential to dramatically shorten that journey. By analyzing a patient's DNA, doctors can identify genetic mutations that may be responsible for certain conditions. This information can help confirm diagnoses, guide treatment decisions, and even reveal risks for future health issues. GeneDx has developed advanced sequencing capabilities that allow physicians to analyze large portions of the genome with high accuracy. The company focuses particularly on exome and genome sequencing. These techniques examine the genetic code in detail to identify variations that may contribute to disease. Over time, GeneDx has built one of the largest genomic data platforms in the world focused on rare disease diagnostics. This data is extremely valuable. Every test performed contributes additional information that helps researchers understand how specific genetic variations influence health outcomes. As this database grows, the company's ability to interpret genetic data improves. This creates a powerful feedback loop. More tests generate more data improves diagnostic insights. Improved insights make the testing platform more valuable for physicians. That type of data-driven advantage can create a strong competitive moat. Healthcare providers are far more likely to trust platforms that have extensive historical data supporting their interpretations. Another important factor is the rapid decline in the cost of genetic sequencing. Just a few decades ago, sequencing an entire human genome cost billions of dollars. Today, the cost has dropped dramatically. Advances in sequencing technology have made genomic testing far more accessible. As costs continue to decline, genetic testing could become a routine part of healthcare. Doctors may eventually order genomic tests the same way they order blood tests today. If that shift occurs, the market opportunity for companies specializing in genomic diagnostics could expand significantly. GeneDx is positioning itself for exactly that future. The company is focusing on expanding its testing volume while continuing to enhance its interpretation capabilities. By combining large-scale genomic data with advanced analytics, GeneDx aims to provide physicians with deeper insights into complex medical conditions. From an investment perspective, analysts have pointed to the company's data platform as one of its most valuable assets. The genomic data collected through years of testing can help drive improvements in diagnostic accuracy and clinical research. This type of dataset becomes increasingly valuable as precision medicine continues evolving. Another important growth driver is the increasing recognition among healthcare providers that genetic testing can play a critical role in patient care. More physicians are incorporating genomic diagnostics into their clinical workflows. Hospitals and research institutions are expanding programs focused on genetic medicine, and pharmaceutical companies are using genomic data to develop targeted therapies. All of these trends support the long-term expansion of genomic diagnostics. If GeneDx continues increasing test volumes while leveraging its growing data platform, the company could benefit from these industry tailwinds. Of course, like any emerging technology sector, genomic diagnostics also comes with challenges. Regulatory frameworks continue evolving. Reimbursement policies from healthcare insurers can influence adoption rates, and technological competition remains strong. However, the overall direction of medicine appears to be moving toward more personalized and data-driven approaches to healthcare. Companies that specialize in genomic diagnostics could play an important role in that transition. GeneDx is positioning itself as one of those companies, and that is why some analysts view it as an interesting growth opportunity within the healthcare sector. Now, when we step back and look at the three companies discussed in this video, something interesting becomes clear. Each company operates in a completely different industry. Applied Digital is building infrastructure for the artificial intelligence economy. Intuitive Machines is helping develop the infrastructure of the emerging commercial space economy. GeneDx is working at the intersection of genomics and precision medicine, but despite operating in different sectors, they share a common characteristic. They are all participating in technological transformations that could reshape major parts of the global economy. Artificial intelligence is changing how businesses process data and automate decisions. Space technology is expanding human activity beyond Earth while creating new commercial opportunities. Genomic medicine is transforming healthcare by enabling personalized treatments and earlier disease detection. These are not small trends. They represent fundamental shifts in technology, science, and global infrastructure, and companies positioned early within these shifts often attract the attention of growth investors. But growth investing requires patience. Many of the most successful growth companies in history did not deliver their full potential overnight. They expanded gradually as their industries matured. Infrastructure was built, adoption increased, and new applications emerged. That process can take years. But when companies successfully execute within rapidly growing industries, the long-term rewards can be significant. That is why investors often study companies positioned at the center of major technological transitions. They are not just investing in individual businesses. They are investing in the future development of entire industries. Now, before we wrap up, I want to quickly mention something for those of you who want to go deeper into stock analysis. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these companies do you believe has the strongest long-term advantage? Do you think artificial intelligence infrastructure, the commercial space economy, or genomic medicine has the greatest growth potential over the next decade? Share your thoughts in the comments because I always enjoy hearing different perspectives from the community. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.